Right now, somewhere in Wyoming, a driver is opening a renewal notice that costs 20% less than the one she opened last year. And right now, somewhere in New Jersey, a driver is opening a renewal notice that costs 20% more than the one he opened last year. Same country, same 12 months, same industry. Two completely opposite letters. One of those two drivers has been told over and over, by headline after headline, that car insurance only ever goes up, that it goes up everywhere, that it goes up for everyone. And here's the strange part. Both of those drivers believe it, even the one holding a rate cut in her hands. This video is going to say something you almost never hear on this platform. Don't panic. And then it's going to spend the next 20 minutes proving it with the industry's own numbers, published in the industry's own reports, filed with state regulators and documents anyone can read. Because the real story of car insurance in America right now is not that prices are exploding everywhere. The real story is that the country has quietly split in two. In one America, rates are falling. In some places, falling hard. In the other America, they're still climbing. And which America you live in has almost nothing to do with how you drive. This is the Owner's Report. Let's start with the story you've already been told, because it's everywhere. Open any feed, any news app, any video about car costs, and the message is the same. Insurance is out of control. Rates are skyrocketing. Everyone is paying more. There's usually a red arrow. There's usually a shocked face. And here's the thing. For about 3 years, that story was mostly true. Between 2022 and 2024, the average cost of full coverage car insurance in the United States climbed by a cumulative 46%. That number comes from Insurify, a company that tracks tens of thousands of real insurance quotes, and it matches what federal inflation data was showing during the same stretch. Motor vehicle insurance was one of the fastest rising line items in the entire Consumer Price Index. If your premium jumped during those years, you weren't imagining it, and you weren't being singled out. Almost everyone got hit. But a story can be true in 2023 and false in 2026. And that's exactly what happened here. In 2025, according to Insurify's National Pricing Report, the average cost of full coverage car insurance in America went down. Not up, down. 6% nationally. 39 states saw average prices fall. 39. 3 states saw drops of more than 20%, and they're worth naming out loud because you will not see them in a headline. Wyoming, Iowa, Arkansas. Each one of those states saw average premiums cut by more than a fifth in a single year. That is the largest broad-based decline in car insurance costs in recent memory, and it happened while most of the internet kept running the same red arrow. Now, hold on. Before anyone gets excited, let's be honest about the other side of that ledger, because this channel doesn't do half a story. While 39 states got cheaper, a handful got dramatically more expensive. New Jersey's average rate climbed 20% in 2025. Washington, D.C. climbed 18%. Rhode Island rose 13%, Michigan rose 12%. And the gap between the cheapest and most expensive markets has stretched into something that barely looks like one country anymore. A driver in Washington, D.C. now pays an average of around $4,017 a year for full coverage. The national average is about $2,144. That's nearly double. Same coverage category, same year, different map. So the headline you've been fed, the one that says insurance is going up everywhere, is wrong. And the comforting version some people want to hear, that relief is coming for everyone, is also wrong. The record says something more specific and more useful. Whether your insurance gets cheaper or more expensive next year depends less on you and more on the state printed on your license plate. Let's look at what the projections actually say for 2026. And let's be careful about who says what, because these numbers come from 3 different research shops, and they don't all measure the same thing. Insurify projects that the national average for full coverage will rise by about 1% in 2026. 1%. After years of double-digit surges, that is essentially a flat line. But underneath that flat national number, Insurify expects costs to rise in 35 states and fall in 15. So the split continues. The country keeps dividing. The Zebra, in its 2026 State of Insurance report, went state by state with quarterly projections. Their data points to the biggest decreases landing in 3 states: Vermont, projected to fall between 6 and 11% in the first quarter and 6 to 13% in the second. Minnesota, down 6 to 8% early in the year. Mississippi, down 6 to 9% across both quarters. On the other end, the Zebra projects the sharpest increases in Oregon, up as much as 17%, Maryland, with second quarter projections reaching as high as 21%, and Utah, up as much as 13%. And then there's Value Penguin, which took a different route. Instead of, quote, data, they analyzed actual rate filings, the paperwork insurers submit to state regulators using data from S&P. Their analysis projects the largest 2026 decreases in Iowa at 6.19%, Minnesota at 5.29%, Arkansas at 4.7%, Missouri at 4.45%, and Illinois at 4.26%. Notice something. 3 different companies, 3 different methods, quote, tracking, market projections, regulatory filings, and they keep pointing at the same kinds of places: Upper Midwest, Northern New England, parts of the rural South, and the Plains. The relief is real, it's measurable, and it's geographically clustered. Which raises the question this whole video actually exists to answer: why? Why does a driver in Burlington, Vermont get a rate cut while a driver in Portland, Oregon gets a rate hike when neither of them changed a single thing about how they drive? To answer that, you need to understand how an insurance price is actually built. And once you see it, you can't unsee it. Here's the machine, plain and simple. An insurance company is a pool. Every driver in a state pours premiums into the pool. Every claim in that state drains money out of the pool. The relationship between those two flows has a name: the loss ratio. If an insurer collects $100 in premiums and pays out $70 in claims, the loss ratio is 70%. That single number, more than anything else, decides whether your rate goes up or down next year. Not your driving, not your loyalty, not the friendly voice on the customer service line, the ratio. And here's the part almost nobody explains. That pool isn't national. It's drawn state by state. Insurance in America is regulated at the state level, which means an insurer files its prices separately in every state with that state's insurance department, and those prices have to be justified by that state's losses. Your premium in Minnesota is not subsidizing a hailstorm in Colorado, at least not directly. Each state is its own pool, its own math, its own filing. So when claims in a state get more expensive, the pool drains faster, the loss ratio climbs, and the insurer files for a rate increase with the state regulator. When claims get cheaper, the pool refills, the ratio falls, and something interesting happens. Competition kicks in. Insurers start filing rate decreases, not out of generosity, but to steal customers from each other. A carrier sitting on a healthy loss ratio in Iowa can afford to undercut its rivals, and in a state where drivers are cheap to insure, winning a new customer is profitable almost immediately. That's the engine behind those 20% drops. Not kindness, arithmetic followed by competition. Now, what makes claims expensive in one state and cheap in another? The record points to a short list, and every research shop in this video names the same items. First, weather. Not weather as in rain, weather as in catastrophe. Hail that totals 10,000 cars in an afternoon. Hurricanes that flood entire dealer lots. Wildfire. States with heavy catastrophe exposure drain their pools in sudden, violent gulps, and every driver in that pool pays for it in the next filing cycle. States like Vermont and Minnesota, with lower catastrophe severity in recent claim data, refill their pools faster. Second, litigation. In some states, a fender bender stays a fender bender. In others, it becomes a lawsuit, with attorney involvement, medical claims, and settlement costs that can multiply the price of a single accident several times over. Industry analyses consistently flag high litigation states as high premium states, and the states seeing relief right now share the opposite trait: lower legal costs per claim. This is why Louisiana and Florida keep showing up at the expensive end of every ranking. Drivers there spend close to 5% of their annual income on car insurance, according to the Zebra's Affordability Index. 5% of everything they earn on one product. Third, repair costs. Modern cars are computers wearing sheet metal. A bumper isn't a bumper anymore. It's a bumper plus radar, plus sensors, plus a calibration procedure that requires specialized equipment. We covered this machine in detail in the windshield video, and the short version is that the average claim severity, the cost of fixing one damaged car, has risen sharply and stayed high. States with dense traffic, expensive labor markets, and newer vehicle fleets feel this harder. Fourth, density itself. More cars per square mile means more collisions per driver, full stop. Rural states with light traffic simply generate fewer claims per policy. It's not a coincidence that Vermont, Maine, and Wyoming sit at the cheap end of the national map, with average full coverage rates around $128 to $131 a month, at least 37% below the national average. Fewer cars, fewer crashes. Fuller pool. And there's a fifth factor, one that sits in your driveway. What you drive moves the number 2, sometimes wildly. The Zebra's report puts the most expensive non-luxury model to insure, the Nissan GT-R, at nearly $400 a month, while a Ford Bronco averages around $76. Same driver could own either one, 5 times the premium. Because the pool doesn't just price the person, it prices the machine, its repair costs, its theft rates, its claim history as a model. A state full of newer, sensor-loaded vehicles files more expensive claims than a state full of older trucks, and that difference shows up in everyone's renewal. Put those 5 together and the two Americas stop being mysterious. The states getting cheaper are, broadly, the states where the pool's healed. The states getting pricier are the states where the pools are still draining. But knowing why costs differ still doesn't explain how a price actually changes. So let's open the machine one layer deeper, because this is the part of the system almost no driver has ever seen, and it's the part that makes everything in this video checkable. An insurance company cannot simply decide to charge you more tomorrow. In every state, before a rate changes, the insurer has to file. A rate filing is a formal document submitted to the state's insurance department, and inside it, the company has to show its work. The claims it paid, the losses it projects, the percentage change it wants, the actuarial math connecting one to the other. Some states run what's called prior approval, meaning the regulator has to sign off before the new price can touch a single policy. Other states run a file and use system where the insurer can start charging the new rate once the paperwork is submitted, and the regulator can push back afterward. Either way, there's a paper trail. A filing number, a requested percentage, a justification, a regulator either accepted or challenged. Every single rate increase that hit you over the last 3 years exists as one of these documents, sitting on a government server. So does every decrease. When Value Penguin projects Iowa falling 6.19%, they're not guessing from vibes. They're reading a stack of these filings and adding them up, which means the rate cycle you've been living through isn't chaos. It's a loop, and the industry has run this loop before, many times, under a name actuaries use in their own conference presentations: the hard market and the soft market. Here's the loop in one breath. Claims costs spike, loss ratios break, insurers file increases, tighten who they'll cover, and some pull out of bad markets entirely. That's the hard market, and it's what 2022 through 2024 felt like from your kitchen counter. Then the higher premiums refill the pools, loss ratios recover, and suddenly every carrier is staring at the same tempting math. Rates are high, losses are stable, and every competitor's customer is overpaying. So one carrier files a decrease to poach customers, then another. Then it's a price war, and rates fall until margins thin out again. That's the soft market. The question was never whether the softening would come. Cycles this old don't skip a turn. The question was where it would arrive first, and the 2025 map answered it. It arrived where the pools healed fastest, and it hasn't arrived yet where they didn't. Actually, hold on, back up one step, because there's a piece of this that deserves more honesty than it usually gets. The 3-year surge, the 46% climb that made everyone furious, where did that come from? Because if you believe the angriest corners of the internet, it was pure greed, a coordinated cash grab, and this channel has a rule about claims like that. Let's look at what insurers themselves were reporting and give their side its fair hearing. During and after the pandemic, the cost of paying claims genuinely exploded. Used car values spiked, which meant totaled cars cost far more to replace. Part shortages stretched repair times, which stretched rental coverage payouts. Repair labor got more expensive. Medical costs on injury claims kept climbing. Accident severity rose. And through that stretch, major carriers weren't quietly pocketing record profits on their auto lines. Industry reporting shows the largest U.S. auto insurers posting underwriting losses, meaning they paid out more in claims and expenses than they collected in premiums, with results dragged down by unusually high loss severity and catastrophe losses. The rate hikes of 2022 through 2024 were, in large part, an industry repricing itself to a world where fixing cars and people had suddenly become much more expensive. Insurify's analysts describe that surge as a catch-up phase, one that was largely complete at the national level by late 2025. That's the Steelman, and honestly, a good portion of it holds up. The pools really were draining, the math really was broken. But, and this matters just as much, a fair explanation for the surge is not a promise about what happens next. Once the catch-up ends, the question becomes whether savings from healthier pools flow back to drivers or quietly settle into margins. And the answer, so far, is that they flow back fastest in states where competition forces them to, and slowest where it doesn't. Which is worth sitting with. The system corrected itself downward in 39 states, not because anyone asked nicely, but because carriers in healthy markets started fighting over customers again. Competition, where it exists, is doing the work. Where it's weak, prices stay sticky. So if the record is this clear, if 39 states already got cheaper and 15 more are projected to fall in 2026, why does the average driver still believe rates only go up? Why did the story never update? Follow the money on that question, because someone benefits from your pessimism, and it's worth naming who. Start with the content economy. A video titled "Insurance Rates Are Collapsing in Iowa" does not get clicked. A video titled "They're Coming for Your Wallet" gets clicked every single time. Panic is a business model, and the everything always goes up story is one of its most reliable products. It requires no state-level nuance, no reading of filings, no map, just the red arrow. There's nothing conspiratorial about this. It's incentives. Fear travels farther than arithmetic. But there's a quieter beneficiary, and this one's documented. The insurance industry itself does measurably better when customers believe shopping is pointless. Here's the mechanism. If you're convinced every insurer is raising rates equally, everywhere, then switching feels like a waste of an afternoon. So you auto-renew. And auto-renewal is where loyal customers slowly drift to prices well above what the same company charges new customers for the same coverage. The Zebra's 2026 report puts a number on what that inertia costs. Their data shows drivers who switched carriers saved an average of $440 a year. $440, sitting on the table, guarded by nothing but a belief that shopping doesn't work. A driver who believes the everything goes up story doesn't shop. A driver who doesn't shop doesn't force competition. The pessimism isn't just wrong, it's expensive. Nobody needed to plan that. There's no evidence anyone did. There is evidence the incentives align, and aligned incentives don't need a plan. Now let's do what this channel always does and draw a hard line between what's confirmed and what's projection, because those are two different kinds of statement and they don't deserve the same confidence. Confirmed in the published record. 2025's 6% national decline, the 39 states that fell. The 20+% drops in Wyoming, Iowa, and Arkansas. The 20% rise in New Jersey and 18% in Washington, D.C. The $4,000 a year averages at the expensive end of the map, all of that already happened. It's history, published in Insurify's pricing report and consistent with regulatory filing data. Projection, not promise. Everything about 2026, the 1% national rise, the 35 up, 15 down split. Vermont's 6 to 13, Iowa's 6.19. These are forecasts built from filings and models, and forecasts carry conditions. Insurify's own analysts flag one openly. Insurers invest the premiums they hold, and when markets perform well, investment returns give carriers room to absorb costs and cut rates. If markets dip, that cushion shrinks, and pressure shifts back onto premiums. One bad hurricane season, one legal shift, one economic downturn, and any state's projection can move. The Zebra also acknowledges that for a number of states, they either lacked sufficient data or the results were too close to call. So treat every 2026 number in this video as a weather forecast, grounded, sourced, and still a forecast. And inside that forecast, a few things deserve their own watch list because they're where the split could widen further. Watch the states where the surge never ended. The Zebra's data flags 6 states where average prices rose more than 50% in a single year from 2024 to 2025: Louisiana, Nevada, New York, Georgia. Maryland, Utah, more than 50% in 12 months, while the national average was falling. If you live in one of those 6, the national headlines about relief must feel like a report from another planet, and in a sense, it is. Your pool is running different math, and the filings in your state will tell you exactly which claims categories are draining it. Watch the affordability gap itself, because it's becoming the real story. When drivers in the most expensive markets pay nearly double the national average, and drivers in Arkansas, Louisiana, and Florida hand almost 5% of their income to this one product, insurance stops being a background cost and starts shaping where people can afford to live and what they can afford to drive. That's a bigger question than any one renewal notice. And watch what happens when a state actually changes its rules, because there's a documented case sitting in the record. Michigan spent years as one of the most expensive insurance markets in the country, driven largely by its unusual no-fault injury coverage requirements. The state reformed that system, and industry reporting 5 years later showed average premiums down 18.8% from where they'd been. Now, Michigan's rates rose again in 2025, so this isn't a fairy tale with a clean ending, but it is proof of something this video has been circling the whole time. These prices aren't weather. They're built. They're built out of legal rules, claim costs, and filed math, and when the inputs change, the price changes. Which means the differences between states aren't mysterious or permanent. They're decisions, sitting in documents, and documents can be read. Here's where this lands in your world. It's a Tuesday evening, the mail's on the kitchen counter, and there it is, the renewal envelope, with that slightly heavier paper insurers use. You open it standing up, the way people open things they expect to hurt, and the number is higher again. Everything you've read for 3 years tells you this is universal, unavoidable, the same letter everyone in America is getting, except now you know that's not true. 39 states worth of drivers got a different letter last year, and the difference between your letter and theirs isn't fate. It's a loss ratio, in a filing, sitting on a state regulator's server, with a document number on it. That letter in your hand isn't the whole story. It's one data point from one pool. The rest of the record is public. Which brings us to where the record actually lives, because every claim in this video is checkable, and checking it costs nothing. The 2025 decline, the state-by-state map, and the 2026 projections are an Insurify's car insurance report, published on their site and updated through the year. The quarterly state projections, the affordability index showing Arkansas, Louisiana, and Florida drivers spending near 5% of income on coverage, and the $440 switching figure are in the Zebra's 2026 State of Insurance report. The filing-based projections, Iowa's 6.19%, and the rest come from Value Penguin's analysis of S&P rate filing data, and underneath all three sits the primary source. The rate filings themselves. Nearly every state runs its filings through a system called SIRF, the System for Electronic Rate and Form Filing, and most state insurance department websites offer public access to it. That means when an insurer raises or lowers rates in your state, there's a document with a filing number, a requested percentage, and an actuarial justification that you can read for yourself. Not a headline about the document. The document. Your state insurance department site also typically publishes approved rate changes by carrier, which is how you can see in black and white whether the companies operating in your state have been filing increases or decreases lately. That's not advice about what to do with your policy. How any of this applies to your specific vehicle, your coverage, or your state's rules is a conversation for that state's insurance department or a licensed professional. This video is about what the public record says. And what it says is that the market has split, the split is documented, and the documents have your state's name on them. So don't panic. But don't look away either. The everything goes up era is over, and it did not end evenly. Some of you are about to get the cheapest renewal you've seen in 5 years. Some of you are in the state still climbing, and now you know why and where the paperwork is. The gap between those two Americas is the thing to watch through 2026, because a national average of plus 1% can hide a 20-point swing in either direction, depending on nothing but your zip code. That's the record. Every report, filing system, and data source in this video is linked below. Read them for yourself. This has been the Owner's Report.